Allow me to introduce David. David's story demonstrates what happens when somebody accumulates wealth and success over a long period of time, and yesterday's tax, investment, and financial plans are no longer effective. David is a successful entrepreneur who has built a very profitable company. He pays enough to support his family and keeps the rest of it inside his company, whatever he doesn't need for his personal expenses, according to the advice that his accountant provides. After several strong years of profit and success, David has accumulated $3 million in his corporation, which is currently sitting in a bank account. His company produces a lot of profit, and he hires the greatest employees who are very thankful for the opportunity to work for such a great and generous employer. On the surface, this sounds like an amazing success story, but this has uncovered a few problems that David has become over time unaware of. He believes that because his company has paid a low rate of tax on his active income, he has believed as well that the investment income that's being produced by this $3 million sitting in his bank account is also going to enjoy a low rate of tax. Unfortunately, this favorable tax treatment is not the case. He's maybe not aware of the punitive tax rate his corporation is paying on his adjusted aggregate investment income. And because he's only considering the bottom line, that is the check that he's writing to CRA every year, this is a very important fact that every incorporated business owner must understand in Canada. Investment income inside a corporation is much more punitively assessed, a significantly higher rate of tax than their active income. As of the recording of this video today, British Columbia assesses a 50.7% rate of tax, and Ontario assesses a 50.2% rate of tax on this investment income inside a corporation. This doesn't mean that investing in your corporation is a complete waste of time or worthless. In fact, all it does is it suggests that the business owner needs to be more proactive and strategic. It should be noted that this tax rate is partially refunded on the payment of a taxable dividend, so let's keep that in mind as we move forward. Effective tax and insurance planning inside the corporation can help mitigate this punitive tax assessment. So let's consider David's example. David's company qualifies as a CCPC, which stands for a Canadian-controlled private corporation. After David pays for employee salaries, his own management salary, other business expenses, whether they are real or notional, the remaining active income is assessed a federal and provincial rate of tax. Now, the income in the corporation is assessed a flat rate of tax. This is very much unlike his personal income, which is subject to the graduated rate system. However, there are incentives under legislation that allow small businesses to compete. And some of those incentives are rate deductions on the income tax paid. That could include the general rate reduction or the small business deduction, also known as the SBD. The general rate reduction is available on qualifying income, such as income that is eligible for other reductions and credits. Investment income, income subject to the small business deduction, and income subject to other refundable provisions under the Act are not eligible for this general rate reduction. Corporations that qualify as a CCPC throughout the year are eligible for the small business deduction. The small business deduction is calculated on the lesser of these three amounts: active income earned in Canada, taxable income, and income up to the threshold of the small business deduction of $500,000. Any income that qualifies under the small business deduction is given a 19% reduction in the tax rate. This is a significant benefit in the corporation to either reinvest that income into expansion, hiring, or making investments in manufacturing or technology. This takes the federal rate of tax on the first $500,000 that are eligible down to 9% in the CCPC. Add in some very favorable provincial rates of tax ranging from 0% in Manitoba or 2.5% in New Brunswick, and you get a range of total provincial and federal rates of between 9 and 11.5%. Anything over this $500,000 limit and you get the federal rate assessment, including the general rate reduction of 15%. In addition to this federal rate, the provinces will add in their own rates of tax, and this can range from province to province. The combined rates will range from a low of 23% in Alberta all the way up to 30% in PEI and Newfoundland. Because David has had some great years of profitability in his corporation, he has built up some retained earnings on the amount of money that he hasn't used to invest or pay employees or pay himself. This creates a significant tax deferral. The rate of tax paid on the company earnings are significantly lower than the personal rate of tax if it was removed from the corporation as salary or dividends. When the funds are eventually paid out as a taxable dividend, the shareholder must apply their personal rates of tax. However, until those funds are distributed to the shareholder, they lie in wait. And some of David's options are just to continue to leave it in a bank account, to actively work with an investment advisor to invest it, or to throw it back into the operating side of the company to expand the business or hire more employees. The ability to accumulate capital on the active income of the corporation and the personal graduated system is a significant advantage for the corporation. The issue arises when that retained capital starts generating its own investment returns, and those investment returns are accumulating a significant federal and provincial combined punitive tax rate as high as 55% in some provinces. As I mentioned before, and to be sure, some of this punitive tax is refundable on the payment of a taxable dividend to the shareholder. But until that dividend is paid out to the shareholder, CRA is going to be just happy to hold on to that tax until the dividend is paid. That refund is tracked through an account called the RDTOH, the Return Dividend Tax on Hand Credit. The RDTOH credit is notional. It is not a cash account with your name on it sitting at CRA. And this account is used by tax professionals to track certain corporate taxes that may be refunded later. The RDTOH credit exists because there is a new tax liability on the shoulders of the shareholder on the payment of a taxable dividend. The income tax system in Canada has been historically based on something called integration. This integration system attempts to produce the same amount of tax payable whether the entrepreneur was paying himself as a dividend, as a salary, or whether he's an employee of another corporation working as a salary and bonused employee. Just because the corporation gets a refund when something is payable to the shareholder doesn't mean the tax has vanished. In fact, it means that the shareholder is now being recognized as wearing the burden of at least some tax on the amount that was originally paid by the corporation. However, at the highest marginal rate paid by the shareholder, there is a small effect of double taxation once it reaches the pocket or the bank account of the shareholder. Only in Canada do you pay one tax to get a refund on the other. So think about business tax rates being applied equally right across the board, but active income is taxed more favorably because of certain deductions allowable under the Act. And investment income, on the other hand, is taxed more punitively than the general rate applied to active income. $100,000 of passive income in the corporation will produce a $50,700 tax bill in British Columbia. The reality is that David may not even realize that different rates of tax apply to different types of income, and that there are specific strategies to reduce the punitive tax assessed on investment income. David should also really consider the effect of the total rate of tax after every credit and every deduction is applied before the money hits his jeans. In short, perhaps a question David should consider is how much usable wealth is available after everything is applied to fund my lifestyle. However, there's an additional word of caution here. A nefarious effect happens inside a corporation on the accumulation of passive income. And this is something that reduces or perhaps even eliminates David's ability to access the small business deduction on his corporate income of under $500,000. When the adjusted aggregate investment income or passive income inside the corporation starts hitting $50,000, the small business deduction starts to grind down. The small business deduction limit is reduced by $5 for every $1 of investment income over the $50,000 watermark. At $150,000 of investment income, the small business deduction may be ground all the way down to nil. And why is this important? Because David's business may still be earning $500,000 of active income. But if all the small business deduction is ground to nil, then all of that income is going to be assessed at the general corporate rates. This doesn't mean that every dollar of tax is permanently lost. Some of the tax may be later corrected on the payment of an eligible dividend. But when this happens, David has lost one of the most significant advantages of owning a small business, and that is tax deferral. More tax is paid today, less capital is in David's hands, and the future potential of that compounding return of that lost capital is now sitting in the hands of the Minister of Finance, not in David's hands himself. Even if the tax loss is temporary, there's an opportunity cost that can never be reclaimed. And if that tax loss endures year after year after year, the compounding effect of this opportunity cost will create a big drag on David's potential net worth. So as I mentioned before, this doesn't make investing in a small business worthless. It also doesn't mean that David should simply empty out his corporate accounts and dump them all into a personal account. There are real legitimate solutions for David. And the first step to all planning is triage. Think about the principles of the medical profession. What good does it do to perform an operation when your patient isn't breathing? That's the significance of the principles of the ABCs of first aid. First, you find if the airway is blocked. Then you find out what the problem is and address the problem with breathing. And only then can you deal with the problems of circulation. Does your patient have a heartbeat? Performing a financial triage is based on very similar principles. We cannot merely jump to a conclusion whether an investment plan or an insurance plan is the right solution. Before any of these valuable options are considered, David needs to consider what the money is supposed to be used for. Is David saving for retirement? Is this money more than he'll spend in his lifetime and earmarked for estate distribution? Or does he need to retain the liquidity for long-term or maybe even short-term business expenses? Is he considering paying out a large bonus to himself or to his employees? Does David have any corporate credit facilities that he would like to pay down or off? The correct plan, strategy, and product depends on the answers to these questions. And recognizing that an investment or an insurance product should not be conflated as a strategy. I can't tell you how many times I've onboarded new clients who misunderstood. They thought they had a financial plan when all they had was a risk tolerance questionnaire to determine the right amount of risk in their investment strategy. Another issue that David needs to consider is the eventual sale of his business. Too many passive assets in his operating company will mean that David will lose the ability to access the lifetime capital gains exemption should he be in a position to sell the shares of the company. A portfolio decision today can therefore mean a massive difference in the corporation overall many years from now. David is going to need to access the right tax, legal, and financial planning advisors in order to address these questions. He is likely going to need to consult with his tax professional in order to find out if a corporate reorganization is the right or maybe one of the right solutions in order to retain his ability to access that lifetime capital gains exemption. Here's the bottom line with all of this. David should not be considering his business to be a tax-free vault or TFSA. The corporation gave him over his lifetime a wonderful opportunity to defer tax and accumulate capital. Significant planning may need to be contemplated in order to retain that tax benefit. Once significant wealth begins to build inside his corporation, David may start to recognize that he has outgrown his old CPA, his old lawyer, and his old financial advisor. I've dealt with many clients over the years who've simply outgrown their professionals, such as people that used to start with a small office accountant, but now have had to realize that they need larger tax advisory services that at CPA simply isn't providing. That's not a knock against the CPA, to be sure. They're probably excellent at filing and compliance, But now that business owner needs a broader range of advisory services that they simply cannot offer. The best investment or insurance plan is not the one with the best return. The right investment product or insurance product is simply part of a comprehensive strategy that tries to maximize the after-tax wealth of the individual and the shareholder of that corporation. And importantly, it meets the specific objectives that David is looking for that money to perform. That is the reality of a successful corporation. If you found this video to be helpful in your journey of politics, history, financial literacy, economics, and philosophy, make sure you subscribe, hit a like, and hit that notification bell for upcoming videos.